Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're having a very good day. Markets are manageable in terms of their volatility at the moment, but certainly we're seeing an overall subsidence in stock values, really predicated around the realization that the banking crisis in the US is not yet complete. It is simmering away, and in fact, First Republic may cease to exist at any moment, as it seems to be slipping down sort of a science fiction film slope into the big jaws of the FDIC, struggling and seeking help from people throwing lines to it, but nothing seems to be working. So it'll be interesting to see how that all resolves itself, but the most likely resolution will be the de facto end of First Republic Bank. And again, it underlines just how much risk is out there still. I can't emphasize enough. It's not seen, it's invisible, but depositors are continuing to withdraw their funds from a lot of small and medium-sized regional US banks. Some are enjoying quite good sort of client retention, but others not. And it's not apparent to us on the outside who is who in this mix. And we will find out about it only as things reach a crisis point. So the whole idea that was behind us, they were isolated events, was false. There are more banking failures to come. That is unfortunately just the case. US bonds, everyone wants to think yields will go down because the US economy will be weak and the Fed will stop hiking. But yields could still go up in a weak economy and with the Fed not raising rates, simply because a lot of investors from outside of the United States might revisit the idea that US Treasuries are the safest place to be, as the debt ceiling issue moves toward some kind of crescendo in the not too distant future, and why take that risk? So we could well see ongoing selling of bonds, yields moving higher regardless of what else is happening, even with a banking crisis and maybe because of a banking crisis. So these are not binary relationships, and I think there is a growing sort of climate of concern among major fund managers and investors around the world to revisit, rethink their idea that US Treasuries are the safest place to be in the world. And as this crescendo kind of intensity builds regarding the US debt ceiling, with the showdown, sort of a high noon showdown, now inescapable, given the bill that the House just passed to sort of renew the debt ceiling, is something that the Democrats, the Senate, and the President will absolutely not accept, which means it just brings things to a head that could work out badly. So stay tuned for what happens there. Don't think it's an actual given that the debt ceiling will be lifted at the last moment and save the day. This time is different. That could happen, but this time is very different. We also saw in the US durable goods orders. They looked great at first look. That was, up 3.2% in March. But this was due to a 78% increase in civilian aircraft orders. Now, those orders come in lumps. And so when they distort the overall number the way they just did, in fact, the overall number without those civilian aircraft and US and defense aircraft too were up a strong 10% or more, I think. But it was certainly civilian aircraft up 78% that had a huge distortion for the month of March. If you take that out of the data series, the last 2 months, including March, so February, March, are both negatives on durable goods new orders. So not quite the rosy economic number that the market thought it was when it first hit the headlines. So the US economy remains in some degree of difficulty. Global economy, as we know, is slowing. There are all sorts of issues out there, and so I don't think the fundamental backdrop is favorable at all for equities at this point. You will see the major big tech firms occasionally surprise to the upside. You may also see them surprise to the downside at some point, but for the moment, they're just sort of surprising to the upside, but not surprising the upside in a big positive way necessarily, just that it isn't quite as bad as people feared. And they're providing what I would term bear market rallies. In other words, I do think the US stock market is now in a fresh, renewed bear market decline. But these events, coming as they do just after the closing bell in New York, are providing some lift to the market near the close or just after the close. That lift can continue in Asia or into Europe but probably less likely actually on this meta one on the day, because Europe was looking very weak in the tech sector in European trading yesterday. Their tech sector isn't reacting the same way the US tech sector is. It's starting to move to the downside, which is dragging the overall market in Europe down now. So just keep an eye on that. But certainly, I think the impact of the big tech slightly better than the worst case that was expected scenarios are only going to provide brief bear market rallies. And I think I would suggest they are an opportunity to sell. I do think that overall, with your investment portfolio still playing defense, is very much the appropriate strategy. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.